We're on the verge of a bond crisis in the United States, and I'm talking about the Treasury market. We're talking about our national debts. And that's just the beginning of the story, because there may be ways to finagle your way out of that kind of a crisis. You cannot finagle your way out of the municipal bond crisis. You can go coast to coast and find little microcosms of the same kind of problem we have at the national level. You can't run the printing press. You have very little power across the country. It's all localized. And yet you've got municipalities who are unwilling to cut their budgets. Unwilling. And this is, I think, one of the gross mistakes that governments, whether it is local or national, make. They hold on to their pet projects until their pet projects are dead pets. I mean, at some point you have to let them go and say, if I can't afford it, I've got to do what I would do as an individual, which is balance my checkbook, which is tighten my belt.
The crisis at the municipal level, which is really an issue for 2010 and 2011, is going to ultimately be put onto the backs of citizens across the country, as whether it's California, Nevada, Florida, Arizona, as those municipalities experience defaults, and ultimately the federal government has to come in and bail them out. That liability gets transferred onto the federal balance sheet, and again, a tremendous amount of pressure on that AAA rating status for our bond.
Another risk to the U.S. bond market is the liability of the Federal Deposit Insurance Corporation. 2009 saw 140 banks and roughly $170 billion worth of funds lost and called for through the FDIC. Over the last several years since we followed this, we've watched the FDIC balance sheet go from a positive $58 billion now to a negative $20.9 billion. The FDIC has been extended a $30 billion credit line, which was then increased to a $100 billion credit line, which was then increased to a $500 billion, a $500 billion credit line. So having negative reserves does put the reserve ratio at the lowest it's ever been in history.
If the FDIC is increasing the number of people that work for them, what is that in anticipation of? With close to 2,500 problem banks and $400 billion in problem assets still with those problem banks, and an institution which is already technically insolvent, how do we navigate these waters? This has added stress and strain to the Treasury market because ultimately the FDIC cannot pay their own bills, and it's you and I, the taxpayer, who will end up footing the bill for the loose lending of the last 15 to 20 years, most acute in the last 5.
Sovereign debt is nothing more than our national IOUs.
T-bills, T-bonds, T-notes, these are what we've been issuing in order to cover the gap between the national income brought in from taxation and what we're spending, our budget. And our budget is simply too big for the income that we have. This year to the tune of $1.56 trillion, too big to match the income, which is in fact diminishing at the same time. Sovereign debt, if you're addicted to debt, if you're unable to live within your means and you have to continue to offer IOUs to the marketplace, the question is who ultimately takes the IOUs? As long as we have a ready audience, there's no problem with sovereign debt issuance. Where you end up with a sovereign debt crisis is when someone says, I'm not interested in your IOUs, or I'm only interested if you pay a significant penalty rate. We're seeing that this year with Greece. We're seeing that to a certain degree with Portugal and Italy. The Treasury market today is like an already saturated sponge. There's only so much that it can take, and we've already reached capacity.
If you continue to take the liabilities of the private sector and put them on
the public balance sheet, as we've done this last year, and as we continue to do, two problems, very significant problems, emerge. One is that of moral hazard. Wall Street understands then that the taxpayer will always back them up. It doesn't matter how speculative the bet, they don't have to pay the price. The taxpayer will do that. We've proven that this last year, and so moral hazard is a significant issue. The second is that you compromise the quality of credit and ultimately the pricing of public debt by shifting those things onto the public ledger.
There's a common misconception with bonds, and it is that they are safer than stocks under all circumstances. And I think the two greatest risks that the bond market faces today are one, liquidity risk, and two, rollover risk. Rollover risk is like what we had in 2008 when corporate interests were financed in 1 month and 2 month and 3 month paper, and when that paper came due, the credit markets had frozen and they couldn't renew the loans, and it put them in a bind, which is exactly the kind of bind that we found, around the turn of the century, 1907. Westinghouse, the great industrial giant, went broke. They went bankrupt because they couldn't roll over their debt. This was not in a debt-frenzied environment. 1907 was long before credit had really been popularized.
We haven't gotten to the point where we have failed auctions, treasury auctions here in the United States. And I don't know that we will, in part because we do have that magical thing called quantitative easing. If there's not enough people to buy our bonds, rather than a failed treasury auction and excess supply, we'll just buy it. A bookkeeping entry. That is the 1970s style monetization, which is inherently inflationary. A rose is a rose is a rose. You can call it anything you want. Quantitative easing, monetization. At the end of the day, we're talking about inflation. The only route ahead for us in terms of our treasury markets is a very inflationary track.
The IMF is best known, along with the World Bank, for bailing out troubled countries, whether it's developing countries, developing nations, banana republics, helping them solve their debt issues. From the IMF website, this year, 2010, the sharp rise in government debt during the economic crisis from already elevated levels helped create what is the newest threat to the financial system: growing sovereign risk.
Our financial system has never been more complex. We've made it complex, particularly since the early 90s, with the full exploration of structured finance and the introduction of derivatives, not just amongst a few elite firms, but as those derivative products have been distributed throughout the world of finance has become very, very complex. You can't change one variable in that complex universe without having an impact on many others. An example of a tightly coupled system would be a nuclear reactor. Chernobyl was functioning quite well. It was when they, ironically, were running safety tests that Chernobyl melted down. In a tightly coupled system, if you change any of the variables, chaos can break loose.
Individual income tax collection was down 20% in 2009. Corporate tax collection was down 55%. Taxation's on the increase, unemployment's on the increase. I can guarantee you, as night follows day, unemployment increases as taxes increase. Your Fortune 500 companies, those companies with a global reach, have the ability to bring their effective tax rate to as low as 7%. So while your middle-income American, the guy who has a landscaping business or sign-making business, these are the Americans that are going to get squeezed. 35% at a minimum. Income tax going to 40%. With all of your ancillary taxes, you're already between 50 and 60% of income. Your large corporations don't feel the pinch at all.
You can look at the movement of the price of gold in the last 10 years as
a significant bull market, or simply as a global no-confidence vote on the US dollar. Individuals and institutions, for the first time in many centuries, has surpassed the gold ownership of central banks. For individuals to be saying, no, I don't want my reserve currency, my savings, to be dollar denominated, euro denominated, British pound denominated. I don't know that I have full confidence in my central banker or in the quote-unquote system. And they are going to gold in ways that we haven't seen since the 1860s to the 1914 period. And today, in the midst of a global currency crisis where currency devaluation competitively, which is forcing individuals and institutions to manage their own household in response to the mismanagement of our money system. More gold today in private hands than at any time in the last 100 years. Does that say anything to you about the way people are voting with their pocketbooks? It should.